Oh, well, I don't want, I'll have that stop.
Why don't you just end the meeting?
No. All right, I started the camera. Started the video. And I guess we'll just wait another couple of minutes.
유료 회원만 테스트하게 해준다고? 왜냐면 광고 다 읽으니까.
Okay, I'm going to assume that was not a question aimed at me. So does anybody remember where we left off last week? Was it 37?
Yes.
Ah, okay. What a good guess. Okay. So, all right. So I guess I'll start talking. So the plan for tonight is to finish chapter 7 and then make some inroads into chapter 8 on sales taxes. Not too much. Once we start sales taxes, you'll know there's only like about 15 more minutes to go in the class. I was getting nervous thinking about, gee, am I going to finish all the things I want to finish? Because I think after tonight we have 2 more classes before the final. I almost said the midterm, before the final. And usually it takes me more than 2 classes to get through sales tax. Usually it's about, I was thinking I might be an hour short. And then it occurred to me, aha, we could schedule an extra class like on, well, it's not like everybody's running out someplace, but we could maybe like on because I did this a few years ago. We actually, during the hurricane year, we lost a couple of classes, so we scheduled one for Sunday night, and then we went out for drinks afterwards. I remember that that class didn't end until about 3 in the morning, but I thought we could, if necessary, I doubt it'll come to that. We can always like schedule an hour, and if people can't make it, it'll be on, they can just check the recording. Maybe that'll just be the final exam review. Okay, so maybe we could do that in a supplemental extra class, unless everybody violently objects, but I think we could do that. So anyway, let's see how fast we can zip through this. This is actually, I would say tonight, this is pretty simple material that we're going through. It's really just illustrating how the apportionment works. And this is really, this in the sales tax is actually the sort of like, like half of the final. The final is a lot easier than the midterm, to be honest with you. And so here we go. So let's just go through it. So we're up to royalty income from intangible property, and you're going to see a constant theme over and over again, which is that for every single topic, which is sometimes treated as a non-business item, there's every single category can have a business side or can have a non-business side. So you're going to see the same, I make the same silly observation over and over again. So number 37, the Disney Corp licenses its film library to a cable TV network headquartered in New York that will broadcast into 23 states. Are these receipts allocated or apportioned, and to which dates? Well, what do you think? What business is Disney in? Are they a broadcaster? Well, of course, this is their business. This would never be anything other than business income, which gets apportioned under, and I'm forgetting which section. Was it section 9? I'm forgetting now. Yeah, business income under section 9. So in fact, I wrote it right here in my answer. So since Disney is in the business of renting its intangibles, section 4 prevents allocation, rather taxable income is apportioned, right? Allocation is one set of rules. Apportionment is the formula factors. Okay, number 38. Apple Corporation writes and holds the copyright to a biography of former CEO Steve Jobs. I think we will all agree this is not what Apple is generally in the business of doing, right? They enter into an agreement with Knopf, a publishing company in New York City, to publish the book. Knopf prints their books in Fairweather, North Dakota. Are these receipts allocated or apportioned? And if they're allocated, to which dates? Well, because this is not the general business of the Disney company to publish books, Section 9 does not apply. So we have to allocate. Which section handles the allocation of intangibles? Section 8. And Section 8 tells us to use direct allocation, but to where? Well, evidently, where the book is published or printed. That's right there in 8C. A copyright is utilized in the state to the extent that printing or other publication originates in that state. So if they print the books in North Dakota, guess what? The income gets directly allocated to North Dakota. So that is perhaps one of the strangest rules I've ever seen, is that why the state that they actually print the books would even fit into this is beyond me. Then the rule continues. And it says, well, what if, for some reason, we don't know where the books were published? That hardly seems likely, but like you wouldn't know where it was published. Well, then it says to allocate to Apple's domicile state, which of course is California. That's not part of the, that's just general knowledge that Apple is headquartered in California. So that would be the answer, either North Dakota, or if we don't know the state where the books are published, then it's Apple's domicile state. And remember, don't feel like you have to sit down and memorize all these rules. That would be ridiculous, actually, to do that. You want to just know what you really want to know is, gee, that's an intangible. I got to look at Section 8. Okay, so and then you read the rule. I was talking there about the final exam. We're not into memorizing in this class. All right, 39. Apple Computer leases some patented technology that it is no longer using. What does that tell you? They are no longer using, to CompuBig Corporation of New York City, which uses the patent to make gunculators in its Philadelphia factory. Are these receipts allocated or apportioned? Somebody sneezed on it, so it must be true that we allocate the income. Bless you, by the way. Allocate, as this is likely to be non-business income, right, under sections 4. And then 8B tells us to allocate this to Pennsylvania, because that's where the patent is going to be used. Part A of 39. If Apple Computer Company is not taxable in Pennsylvania, where is the income allocated? Well, there's a rule in 8B. If you don't know where your lessee is going to be using the property, allocate it to the domicile state. In this case, California. And remember, can a company ever have more than one domicile under these rules? No, there's only one per customer. So now different states may define it differently, but under any set of rules, they have to be such that there can only be one domicile state. Okay, part B. What if it is unclear where CompuBig was using the leased technology? Didn't I just say that? What's the difference between A and B? Oh, I'm sorry. I answered B before. Let's go back to, nobody even pointed that out, that I was answering the wrong question. Okay. I answered part B, that if you don't know where CompuBig is using the property, you allocate it to California. In part A, what if Apple Computer is not taxable in Pennsylvania? Where is the income allocated? And in that instance, it's allocated to the domicile state. So it's really the same answer to both, right? If the company is not paying tax, if the taxpayer is not paying tax in the state where the intangible is being used, or if it's unclear where it's being used, then our default rule is the state of domicile. All right, number 40. Merrill Lynch is headquartered in New York, but has offices in 50 states and is a dealer and market maker. That's the quote, that's the term, the market maker in NASDAQ stocks and bonds, for which it maintains inventories. In 2013, these stocks and bonds are sitting on a shelf waiting to be sold, just like shoes in a shoe store. And they generated trading gains of $100 million. So in other words, the company, Merrill Lynch, was just holding, I know they're not, they're in business, I'm sorry. So Merrill Lynch, they're holding all these stocks, nobody buys them, and while they go up in value. Well, in other words, as I wrote here, they bought low and they sold high. Is this income apportionable under UDIPTA? Well, they're in this business, right? This is actually their inventory. So just the way shoes in a shoe store might go up in value, and these stocks go up in value. The only difference being is that in a shoe store, you don't mark to market the value of your inventory, but a securities business does. By mark to the market, a dealer is required to pick up the gain in his inventory or the loss in his inventory. So at the end of each year, if you bought it at 40 and now it's worth 50, you value it, you pick up the difference, you pick up that gain of $10. So in this instance, where the question here is, well, do we allocate this or apportion it? Well, this is their business, so it's going to be apportioned, right? So it'll be apportioned under Section 9 of UDIPTA. Okay, number 41. Bingo Box Corporation is incorporated in Delaware with headquarters in Maine and operates in 15 other states, including Vermont. The company owns 10,000 shares of General Electric stock, which it has been holding for 15 years. And in 2013, they sold the shares for a $300,000 profit. Is this income apportionable or allocable under UDIPTA? Well, think back a few weeks ago. Is this unitary income or is this investment income? Right? It's investment income. This is under Allied Signal. This is a long-term, it's not working capital, it's a long-term investment that the company held. Accordingly, the profit on, Bingo Box is not a registered broker dealer. Therefore, this is not business income. This is investment income to them. If it's investment income, it gets allocated under Section 6C. Section 4 sends you to Section 6C, capital gains from the sale of intangible property. And Part A, if allocable to which state? Well, Maine, the state of domicile, the state of commercial domicile. Okay. Any questions? Nothing. Okay. 42. Following up on the previous question, in 2013, Bingo sold the land and factory under the building for a $2 million gain. Is this gain apportionable or allocable under UDIPTA? So what do we have here? I'm sorry. I'm being a little slow tonight. I've had a long day. So we would assume, I think, if they're selling the land under the factory, it's highly likely to not be a business income, and it would be non-business income, and therefore this gain would be allocated under Section 6A. Where do you think? Well, real estate has a different rule. It's not allocated to the state of domicile. It's allocated to the state where the land is located. So I didn't say where the land is located. So we'll just have to. The answer is wherever the land is, it's going to be the gain is going to be allocated to that state. Okay, same as the last question, except that in 2013, Bingo also sold machinery used in Maryland for a $100,000 gain. Is this income apportionable or allocable under UDIPTA? Well, as you will recall last week, they're selling the machinery that's used to make the inventory. And there's a little bit of a difference of opinion here among the states. In this instance, the so-called functional states would want you to apportion the gain the so-called transactional states would want you to allocate the gain. And if we allocate the gain, it'll be, of course, to Maryland. If so, I kind of went over that in detail last week. If you didn't listen in last week, you might be a little bit lost right now on the functional states versus transactional states. But to sort of repeat that, this is where there's a little difference of opinion in how to interpret UDIPTA. Some states would, and the focus here is on, not on the inventory, because of course the sale of inventory is always going to be apportioned, right? But the issue here is, what about the machinery that's used to make the equipment? And there are some states that say, hey, treat that as business income as well, the so-called functional states. The transactional states say to treat that type of a gain as a Section 4 allocation item. And then Section 4 would lead you to Section 6B1, and we would allocate this gain to Maryland if Maryland is a transactional state. Okay, with me? Still getting dog comments, that's nice. Okay. And we have 84 people online, so that's great. Okay, 44. Same as the last question, except that bingo is exempt from tax in Maryland. Is this income apportionable or allocable under UDITBA? If allocable, to which state? Well, in this case, under Section 6B2, the gain would be allocable to Maine, the state of commercial domicile. So that would be set under Section 6B2. All right, number 45. Might be interesting if we had some volunteers here. 45, in 2013, Bingo sold a patent which it used in the Vermont plant for a $50,000 gain. If this income is apportionable, or is this income apportionable or allocable under UDITBA? Well, what's the first question we ask ourselves? I need a volunteer. I know, I'm asking for trouble. Imagine I'm talking, it takes some guts to speak up, right? To hit the button and speak. Is somebody coming in? I guess not. Okay, I'll just answer. So, assuming that this is non-business income, which I imagine it would be, the income is allocable to the taxpayer's domicile. So under 6C, it would allocate to the domicile state. What did I say that was? I didn't. So it would allocate to the domicile state. All right. Interest and dividends is our next little subject. So pretty soon we'll be, just 2 more questions, we'll be through this allocate versus apportion.
Hey, Professor.
Oh, yeah. Hi.
I have a question. For this last example, you said that the answer was Section 6B2?
6B2, yes. That would be for 44.
For 44. Okay, sorry. Did we do 45 yet? I
thought I did.
Okay.
Yeah. Okay.
So
45 is allocable under Section 6C.
6C. Okay. Why wouldn't it be Section 8B?
Now you're making me grab the book. Okay, that's fine. Because I got to look at 8. All right. Well, this will be embarrassing if you're right. Hold on, I got to. Which? Where is? Wait a minute. I took the 11th edition. I think I'll go back to the 10th because I think I have it. No.
At the end of 8B, it also says the patent is utilized in the state in which the taxpayer's commercial domicile is located. So it ends up being a similar result. I'm just not sure why you would.
But we should give you the right section number, right? I owe you at least that much. Okay, for somebody, and if you have the book, if anybody has the book, what page is UDIPTA on? Oh, I think I found it. What page are you on? Here it is. Okay, so you're questioning, why isn't it 8C? And I have this, we're dealing here with a patent, right? It's number 45. 8C is dealing with copyrights, a copyright.
8B.
Oh, B as in boy?
Mm-hmm.
Okay. And I said 6C. Oh, you know why? Because it's a capital gain. Section 8 deals with royalties. See that? Patent and copyright royalties. Section 6 deals with capital gains. Here we're actually selling the patent. So it's covered under Section 6.
Thank you for clarifying.
So I thank you for bringing up the question. That was a very good question. I'm going to keep the book open now because you're asking good questions. Thank you. All right. So number 46. Merrill Lynch is headquartered in New York, but has offices in 50 states and is a dealer and market maker in NASDAQ stocks. Okay, this sounds familiar, right? And for which it maintains inventories. In 2013, the stocks and bonds sitting on a shelf waiting to be sold. I did my shoe store thing, paid out $40 million in dividends and $60 million in interest. Is this apportionable under UDIPTA? Well, what do you think? They're in the business. This is their business. This is not some idle interest that you earn. So this would be apportionable income under Section 9. 47. Go back to good old Bingo Box Corporation is incorporated in Delaware with headquarters in Maine and operations in 15 other states, including Vermont. The company owns 10,000 shares of General Electric stock, which has been holding for 15 years. The stock paid out $40,000 in dividends in 2013. In addition, the company also has $100,000 in U.S. Treasury securities, which it held for 5 years. In 2013, it paid out $3,000 in interest. Is the income apportionable or allocable? And well, I dare say this is allocable income. This is allocable non-business income directly allocated to the commercial domicile in Maine under Section 7. And if you look, Section 7 deals with interest and dividends are allocable to the state if the taxpayer's commercial domicile is in this state. So, okay, so Section 7 is our interest and dividend section, but again, only if it's not business income. Only if it's non-business income. All right, so now we're sort of up to the main event, and this is how do the different apportionment rules work. So now we have apportionment of business income. What are the three factors that are the components of the general business formula under UDIPTA? And what are the relative weights given to each under UDIPTA? Well, this was written back in the 1950s, back when they thought three-factor formulas were the key thing. So if you look at Section 9, they're each given a 1/3 weighting. Okay, so it's 1/3 property, 1/3 payroll, 1/3, whatever I left out, sales. Okay, Company S, number 49. Company S has a payroll factor of 15%, a property factor of 16%, and a sales factor of 2%. So how would we figure out what their apportionment is? Well, you would add 15 plus 16 plus 2, add them up. That comes to 33. You divide by 3, you have 11% apportionment for that company. With me? That's pretty simple. Okay, so now I told you the most basic. Now let's get into how are each of these factors actually computed, which is the next subject that we get to. So the property factor, let's start there. What is the general formula? And by the way, the property factor is probably it's not easy. It has its own little tricky aspects to it. So what is the general formula and what metrics are used? Does the formula include rental property or only fee-owned property. I'm being lawyerly there. Fee-owned property just means property that you own rather than property that you rent. So under UDIPTA, it speaks about the original cost of the property, whatever you paid for it. Now, among the states, in reality, that's not often used. Often they use fair market value of the property, which is almost impossible. How are you going to go revalue your property every year end to figure that out? Other states use or I should use the past tense, used to use your book depreciable basis. So whatever the book value was, so it was cost less depreciation. Even UDIPTA says if you don't know the original cost, use the fair market value if the cost is not known. I'm not sure why you would not know what you paid for something. I guess if your accounting record's burned in a fire, then you might have to resort to fair market value. All right. So for property that you own, whether it be real property or tangible personal property, we use the cost value for what we own. So let's do the numerator. It's the average cost of real property in state. Now, what do we mean by that? Average. Wait, do I do that in the next question? Well, let's just talk about the general rule. So the average cost, what we typically do is we take the beginning cost at the beginning of the year, and then we look at the ending cost. And we average the two together. So for example, during the year, you might have sold some property, you might have bought some new property. So you take the beginning and you take the end, you add them together, you divide by 2, and that's the fee part or the cost part of the numerator. So you would take the in-state, the beginning in-state property, the ending in-state property, average them out. But then they want you to include rental property as well. Now, keep in mind, you're mixing and matching. You're comparing apples and bananas at this point. How do you compare the cost of property that you bought with only the rental part that you pay? It's not really a fair comparison because things cost a lot more than they do to rent, right? If you buy something, you own it over a long period of time, but you paid a lot of money up front. And then let's say in state red you buy, and then in state blue you rent. Well, you could have exactly the same item of property, but the state where you bought it, it's going to be a much higher property number. So what the law does is they create a capitalization. And the UDIPTA capitalization is to take the rent that you pay for real and personal property and multiply it by 8. Okay, to try to create some sort of an equivalency. And that was actually a standard that was pretty much adopted by the state. Some states use the capitalization of 7. I'm not quite sure why, but the majority rule by far was 8. So it was, again, let's say we were doing New York. It would be the average cost of property in New York plus 8 times the rental cost of property in New York, or the amount that you paid in rent that year. What's your denominator? Well, beginning and ending cost for all property that you own anywhere in the entire world, plus 8 times the least value, the amount that you paid in rent that year for all of the property that you own anywhere in the world. And you notice I didn't make a mistake there. When I said world, I meant world. I didn't mean the United States. So if we were doing the New York property factor, it would be property owned and leased in New York divided by property owned and leased all throughout the world. Okay? And I think I covered that. All right. Let's go to 51. X Corporation owns $30 million of property in State Orange out of a total of $40 million everywhere. X also pays the annual rent of $2 million for property in State Orange out of a worldwide total of $9 million. What is the property factor? In Orange, you dipped to state. Okay. So they own 30 in Orange. So our numerator is 30 plus, and then we rent 2 million. So it's 2 million times 8. So we have 16 million of leased property, 30 million of owned property. Our numerator is 46 million. Our denominator, well, we have the 40 million of owned property, and then we add to that 8 times the amount of rental expense that we pay all throughout the world. So that would be 9 million times 8. And add it all together, our denominator is 112 million. Our property factor is thus 46 divided by 112, and it equals 41.07%. That would be our property factor for this company. 52. Jones Corporation purchased a business asset in blue for $10 million 3 years ago and held it for all of 2013. On December 1st, 2013, the company purchased for $36 million a business asset located in green. Compute the property factor for 2013. Well, here's the problem. Can anybody think, what is the issue that's being raised here? Anybody wanna? December 1st, 2013, we buy a very expensive asset, and we're trying to figure out the 2013 property factor. Well, I think the issue is that it's a little distorted, right? Because we didn't own the asset for the entire year, right? But we're going to give it 50% credit, right? Remember, we figure out by taking the beginning, which is 10, and then we take the ending, which is 10 plus 36, which is 46, right? And no, wait a minute, did I get that right? Yes, I got that right. So it's going to be a little distortive. The fact that we didn't own the asset for the entire year. We bought it, nor did we even own it for half the year. We owned it only for a month. So the point here is that they make in section 12 is that normally taking the beginning and the ending is just fine, except when you have real distortion coming into place. And you would have distortion if you doubled your assets 30 days before the year ended. So what they say there is to do a weighted average of month by month, okay? And so we count the 36 million for 1 month, and then we count the 10 million for 12 months, and we do a weighted average of that. So the law allows you to use, it actually allows you to use quarterly averages or monthly averages, or I guess if you bought the asset on December 28th, even daily, weighted out by days, by the number of days, and to get the most accurate number possible for the property factor. So I don't know if you want to write this all out, or you'll just, I'll tell you what, I'm going to be posting the answers. I'll give you my detailed calculation. I'll be posting the answers probably tomorrow. So, or should I go through it now? It's a little hard to go through it now. It's just like reading. It's just babbling off a calculator. We'll let it lie. We'll let it lie. All right. 53. So, keep in mind. So you're dealing with me here. Is this something I'm likely to test you on? Yes. An ability to identify that you can't use beginning and end because there's a big distortion right there. So highly suspect that will work its way into a true false question on the final. All right, 53. So circle 52. All right, telling you right now, likely to come up. 53. Referring back to the previous question, Jones Corporation operates paper mills in Alaska, Alabama, and Brown. The company also owns a mill in Brown that was taken out of service in 2013 as the declining economy did not justify the company keeping the oldest plant in service. The company has retained the plant, however, with the intention of reopening it if orders pick up in 2014. Alaska utilizes a three-factor formula of property, payroll, and sales in computing the company's taxable income in Alaska in 2012. Should Jones include the value of the company's property in brown in the Alaska property denominator? And then I'm saying, consider, well, this is a case that's right out of the book, consider the opinion in Amico. And so in other words, do we take property that's been taken out of service but still being held by the company, and do we include that in the property factor? The answer is yes, we do. The fact that the property is available is sufficient, okay? So it's sufficient for it to be included in the property factor. In the Amico case, it was like a fascinating case because the company had taken out of service, just like they are. Very timely question, right? What's going on as we speak? Are oil fields being opened or are they being closed? If you've been reading the paper, you'll notice the other day, did anybody know what the price of oil was like about 2 days ago?
It's negative.
It was negative, right? They had you didn't pay for it. If you were willing to buy a barrel of oil, they paid you $36 to take it away, something like that. So this is again among the many casualties of the situation that we're in right now. Is I would have to imagine that every oil field in America is just being closed down right now. So you can expect those million people to be on relief next week, or unemployment insurance. Evidently, I think in the U.S., it's actually, it's expensive to get oil out of the ground in the U.S. as opposed to other countries like Saudi Arabia, where it costs very little to get the oil out of the ground there because I guess it's close to the surface. You stick a nail in the ground and oil pops into the air. Whereas in the U.S. you have to go deep and there's environmental standards and all that. You need I think that as soon as the price goes below $35, it's impossible to produce oil in the U.S. So our production is shutting down. And I guess, so you might be wondering, well, do I include the value of all those fields? Are oil fields expensive? You bet. Companies pay billions of dollars for the rights to own, to have oil leaseholds, over, oil-rich lands. And the question would be, do we include that out of service property in our property factor? The answer is, according to, at least in Alaska, the answer is yes, you include it in the property factor. As long as you can reasonably bring it back into service, you would include it. Now, let me change the facts a little bit. Let's just say, now I imagine, who knows, maybe in a year or two, oil will be back up in value again. It's actually something to look forward to, that it'll actually be up in value again. It'll mean things have returned to normal. But let's say it's never going to return. No, God forbid. I don't even want to say that out loud. Let's say that there's an enormous breakthrough in wind power and in such that all energy is now from renewable sources. It's either from the wind or it's from solar. We're slowly getting there anyway. So as a matter of fact, oil values have been declining over the last few years. It's getting cheaper and cheaper to buy oil lands because it's commonly thought that 10 years from now, no one will be using oil anymore. So if that was the case, and it looked like, experts would say, this oil field, you might as well turn it into a baseball stadium. It's worthless. It's worthless crap in the ground. You'll never use it. I guess at that point, the property is no longer considered in the property factor because it's not something that will ever be brought back into service again. And of course, at that point, you would probably take an abandoned property loss for tax purposes, for federal tax purposes. So you wouldn't even own it anymore. You would just say, hey, it's worthless. I'm writing it off. Okay. 54. Would your answer change for Jones's Alabama return if Alabama adopts the UDIPTA regulations? Oh, did I want, do I, should I of course this question out? Yeah, let's go with it. I don't know why I said the UDIPTA regulations. Well, so, same answer. Under UDIPTA, we include property in the factor that was being used, but it's been taken out of service. I'm not even quite sure why I'm asking the same question twice. Now, what is a valid question is 54A, hypothetical. What if taxpayer is constructing a new plant in New York? On the last day of the taxable year, the plant is only half built after expenditures of $3 billion. Can this property be included in the denominator of the taxpayer's state Brown tax return? The answer is no. Property has to be placed in service in order for it to be included in the property factor. With me so far? So it's funny, property that you're building doesn't get counted. Property that you bought but took out of service does count in the property factor. Question 55. Say Jones Corporation owned intangible property and the company is headquartered in Brown. Would the value of the intangible property be included in the numerator or the denominator? I should say, and the denominator of the property factor of any of the states that the company files tax returns? No way. That's the answer. Under Section 10 of UDIPA, we're only concerned with tangible personal property and real property, not intangible property. Why is this the case? These laws were written back, I think, in 1957, 58. I was only a year old. Intangible property just wasn't important back then. And I think that's something they're reconsidering now. Maybe that does belong in the property factor. Okay, so that's 55. We only include tangible property, not intangible property. All right, I'm done with the property factor. Let's move over to payroll. What is the payroll factor for the Universal Import Company when it pays its 5,000 employees in India $50 million and its 600 employees in State Orange $50 million? So what's our apportionment? So they have 5,000 employees in India, they have 600 employees in Orange, and wouldn't you know it, they're making exactly the same amount of money. So what's our property factor in State Orange? Do we figure it out per person, or do we figure it out based upon the total payroll? Well, we base it on the total payroll, which is one of the arguments that the payroll factor is itself somewhat distorting because of pay differentials in different places in the world. If you think about it for a second, who do you think is, which state do you think is contributing more to their welfare? India, if we consider India a state, and we know UDIPTA, we do consider it a state. India or Orange? Well, I would say the 5,000 employees in India are producing more than 50% of the value for the company, right? There's just so many of them. So, but the payroll factor doesn't bring that type of distortion into consideration. It might actually be the basis, as we will see later on in the apportionment section. There's a section dealing with distortion. That could probably be an argument that could be made under this section saying that, hey, my payroll has to be adjusted because it's not taking into consideration all of those thousands of people outside the United States. They're not batting at the same level. And by the way, this is a very real world type of situation. Where do you think accounting firms have outsourced a lot of their tax return preparation? Other countries where most notably India, but also Argentina, Uruguay, Chile, I know we have EY. I know we have major outsourcing centers in each of these countries. And so it's sort of a fact of life that it's not just factory situations that get shifted overseas. It's also white collar work that gets shifted. 57. By the way, does anybody know, a little trivia, we're making this trivia night. Who is the most famous employee of the Universal Import Company? Anybody know? Okay, we get an extra grade on the final. Anybody know who works for the Universal Import Company? Everybody's feverishly looking on the internet. I'm surprised you don't know this. That is the fictional employer of James Bond, the Universal Import Company. Okay. 57. The Duda Manufacturing Company employs Lucas to sell sporting goods equipment. Virtually all days, Lucas reports to work at the company's offices in Queens. If New York uses the UDIPTA rules, where is Lucas's compensation paid? Well, under 14A, I should go look at it myself, 14A. If the employee's services are entirely performed within a particular state, then it's an easy question, right? The services all of the services are provided in New York. 58, same as the last question, except that Lucas works from a client location in Maryland for several days each year. If New York and Maryland both use the UDIPTA rules, where is Lucas's compensation paid? Well, we would look to section 14B and section 14C, and it comes up with the base of operations rule. And it says basically, it asks the question, where is this guy's boss? Who does he report to? Where does he normally work? Well, under this question, it's easy, right? He's 90% of the time he's in New York, 10% of the time he's in Maryland. Clearly, New York is his base of operations. So in this instance, we would say we would include his payroll entirely as in the New York numerator and not in the Maryland numerator. 59. Same question as before, except that Lucas works from his home in New Jersey every Friday. If New York and New Jersey both use the UDIPTA rules, where is Lucas's compensation paid? Well, the answer to the question is in section 14C1. Look to where the base of operations is. Include payroll in this state so long as he provides some of his services in the base of operations state. So obviously here, New York is base of operations. He's only working from home 1 day a week. He's spending virtually all his time in New York, or even some of his time in New York. It would all become New York payroll. Incidentally, just moving away from the questions for a second, this has been an issue that's come up a lot lately, where all of a sudden people like me are working from home. I normally work in New York, and suddenly I'm working in New Jersey. And the issues, of course, came up. To which state should my employer be paying my payroll taxes? When I file my income tax return, should I report this as New York compensation or as New Jersey compensation? Makes a big difference for my personal income taxes. Surprisingly, New Jersey said that I am to treat my income as New York income. So New York is getting a windfall out of me. I will be paying all of my taxes to New York this year, very little to New Jersey, because even though I'm sitting here in this room every day, it's being considered to be New York income. So that's just, New Jersey this is the same thing New Jersey did after 9/11, where entire companies had to physically, the companies that were located around the World Trade Center, they all had to physically relocate to New Jersey. I remember the American Express company moved to New Jersey, and yet New Jersey said, you know what, we don't want that. We feel bad about that. We don't want that income. Treat it all as New York source income. We're good guys in New Jersey. So what am I up to? 60? Okay, I think I'm up to 60. What if Lucas was a traveling agent of the company on the road 365 days a year, spending a few of those days at New York clients? He reports to Josh, a manager in the New York office. If New York uses the UDIPA rules, where is Lucas's compensation paid? 14C, if he works in New York at least a little bit, and he is supervised from New York, the payroll is sourced to New York. 61. Now, of course, I'm trying to build every little crazy point into this. Same as the last question, except that Lucas reports to Josh in New York, but returns to New Jersey each week to his house. Lucas spends a few days each year visiting New Jersey clients, but spends no time in New York. If New Jersey uses the UDIPTA rules, where is Lucas's compensation paid? Okay, well, finally, under these rules, which are, by the way, are not the actual rules of New Jersey, but I'm just using it as an illustration. Under UDIPTA, finally, Lucas's income gets sourced to New Jersey because he doesn't work a single day in New York, but he does work a few days in New Jersey, and he lives in New Jersey. So if you look at 14C, all of those factors add together, and we finally have income source to New Jersey. Now, if for one day in that year he worked in New York, it would change the answer. It would become New York source income in that instance. That's where these rules are a little weird, because you shouldn't have such momentous change based upon one day's activities. Okay. Let's move on. Number 52. Okay, the Halley Corporation and its subsidiary Emily Corporation are both organized under the laws of Delaware, and both are headquartered in Pink. All of the employees of the combined companies are employed by Halley. To the extent that Emily needs workers to perform its contracts, Halley employees do the work, and Emily pays a fee to Halley. If Pink does not have a combined reporting law, should Emily report the fee that it pays to Halley as part of its payroll factor? So in other words, and this was a case in the book, the Cincinnati case. I can't even begin to tell you how many people over the course of my career, people come up to me and says, you know, I was laying in bed last night and I had this great idea. Why don't we get the payroll? We're paying so much tax in New York. Why don't we get the payroll out of this company by setting up a new company, and we'll put the employees in the other company, and they'll just work for the other company. And this way we've eliminated our employees, you know, so in other words, you put them in a related company. Well, the jails are starting to fill up with people who've tried this one. So I would say, don't do this. And it's amazing how many people I've said, you know, I'm glad that you're thinking out of the box, but believe it or not, that one's been done before, and it hasn't been well received. That when you try to turn employees into independent contractors simply by setting up another company. So it's just not going to work. Okay, you're setting yourself up for big penalties if you do something like that. All right, everybody with me on that one? You see why it's distortive? So you only, I guess what's wrong with the payroll factor is that you only include employees, you don't include independent contractors. So it's almost like they're sitting up begging for people to pull some crazy stunt like that. So again, if you don't get caught, it's a great idea. If you do get caught, it's a really bad idea. You should never have done that one. Okay. 63. What if instead of employing personnel of its parent, Emily hired cats and cats CPAs to prepare its tax returns. Should Emily include the value of the fee as payroll in computing its property factor? Well, I've already answered this one. You only include employees in the factor. But you certainly don't include independent contractors in this particular instance, right? An odd person. Otherwise, it would be impossible to calculate. Imagine if you had all of the different people that you hire to do little things that are remote. Now, notice how this is different from the previous question where the whole thing was just a silly scam that was being set up, right? So scams are ignored. Real independent contractors situations do not affect the computation of our payroll factor. Okay, with me? Questions? All right, I've deserved a sip. Okay. The sales factor. Okay, define the numerator and the denominator of the receipts factor, number 64. Well, that's easy. That's in section 15. If the state is orange, it's going to be orange receipts divided by all receipts. That's your sales factor or your receipts factor. 65. Now, of course, we know in actuality, it's going to be more complicated than that. 65, consolidated lint ships 500 tons of lint via common carrier from its Reading, Pennsylvania warehouse to a customer in Georgia for $30. The shipping terms are FOB Athens, Georgia. That's free on board Athens, Georgia. Free on board is like an insurance term. It means they've got the insurance, they've got the risk of loss up into Athens, Georgia. Consolidated lint is subject to tax in Georgia. If Pennsylvania and Georgia both adopt UDIPTA, to which of these two states is the sale included in the numerator? Well, the shipment of tangible personal property, if we look at section 16, says it's done on a destination basis. Okay, FOB is never relevant. You'll see that all the time. You'll see that on my final exam. FOB is not important. It's to be ignored. It's just noise. Okay, so it's basically when you're dealing with shipping with property, it's always done on a destination basis. It's where you're shipping the property to. So in this instance, it's leaving Pennsylvania, but it's being shipped to Georgia. It's going to be included if you're, so long as, how about for now, I'll say this taxpayer is filing in Pennsylvania and he's filing in Georgia. So this will be a Georgia receipt. 66. Same as the previous question, except that the lint is shipped via common carrier, FOB, Reading, Pennsylvania. So in other words, they're only shipping it, they're only paying the insurance. They're not paying the insurance. The buyer is paying the insurance. Does that change the answer? Well, what did I just say? FOB is not relevant. This sale, the money earned on this sale will be sourced to Georgia. So it's included in the Georgia numerator. It's not included in the Pennsylvania numerator. 67. Referring back to questions to where the lint is being shipped via common carrier from Pennsylvania to Georgia, to which of the two states is the sale included? Boy, this is really strange language I've come up with here. I think I need to grammatically check all this. Okay, I'll repeat it again. 67. Referring back two questions to where the lint is being shipped via common carrier from Pennsylvania to Georgia, to which of the two states is the sale included in the numerator if consolidated lint does not have Georgia nexus? So the question I'm asking here is, we're shipping from Pennsylvania. We're shipping to Georgia. And up until now, I've said we've been filing tax returns in both states. Now I'm saying we only file tax returns in Pennsylvania. Now where does the sale get sourced? Well, if we look at section 16B2, it gets sourced to Pennsylvania. This is the so-called throwback rule. So if you're shipping to a place where you're not filing a tax return, it's sourced to where you shipped from. Many states do not have a throwback rule. If Pennsylvania did not adopt the throwback rule, well, then where would the sale be located? If you're not filing in Georgia and Pennsylvania does not have a throwback rule, where does the sale get sourced? Nowhere. This is what, as a state and local tax planner, this is what you want. This is heaven. This is what we aspire to. We want as many nowhere sales as we want. So it doesn't, the answer is it doesn't get sourced anywhere. So if you're a state that does a lot of shipping, or let's say wants to develop its warehouse industry, would you have a throwback rule? Well, the answer is no, because you've eliminated the possibility of a nowhere sale. As soon as you have a throwback rule, it doesn't matter where you ship from. You're either going to pay tax where you're shipping it, you're either going to be included in the numerator of the state where you're shipping it, or it'll be included in the state that you're shipping from. Now, are there states that rely very heavily on warehousing and shipping? You bet. As a matter of fact, you know what the big shipment states are? Kentucky and Tennessee are your big shipment states. That's where like the whole pharmaceutical industry ships out of those locations. Why Tennessee and Kentucky? It's the logistical center of the country. Like if you look on a map, Tennessee and Kentucky are not in the middle of the country. They're sort of clustered closer to the East Coast, right? They're much closer, but by center, I mean, that is the center. If you weight the geography by how many people live in the East and how many people live in the West, that's the logistical center. And that's what's important because obviously they ship more to the East Coast than they do to the West Coast if there's more people living in the East. So, and neither, as you would think, neither Kentucky nor Tennessee have a throwback rule. That would probably be, notwithstanding their great geographical advantage, they would probably lose all of those warehousing businesses if they didn't take out of their version of UDIPTA the throwback rule. I sort of learned this in a very interesting way when I had to visit a client in Memphis, Tennessee, and I got there the night before, and I figured, I don't feel like going. You know, you arrive late at night. You arrive at 11 o'clock at night, you don't feel like going downtown to a nice hotel. I decided, I'll just stay at the airport. I'll go to the company in the morning. That was a big mistake because anybody know what company is headquartered at the Memphis airport? Federal Express. And those planes don't operate during the day. They operate at night. In fact, I didn't sleep a wink the entire night. I was laying in bed, all hearing every 3 seconds, it seemed like another plane sounded like it was going to land right in my hotel room, which by the way, if you're building a hotel at the airport, you would think they would make it soundproof, but they didn't. And I remember going to the client the next day and this person said to me, "You look like you didn't sleep last night." And I said, "I didn't." So yeah, so that is the logistical center of the country. All right, what am I up to? Okay, I did 67. All right, 68. Same as the last question, except that the customer sends its own trucks to Reading to pick up the lint and they drive it away to Georgia. Well, this is a so-called dock sale where the person selling doesn't ship the product. The buyer comes and picks it up. Authority is mixed on this particular point on what the law is. Law can be read either way. In the Gilmore case, which is in the book, the sale was sourced on a destination basis. I think that's probably the majority rule among that, even when somebody comes and picks it up, it should go to where they're taking it. And in fact, Hellerstein makes that point very strongly in the book. All right. 69. You are the owner of Ike Davis baseball bats, the bat that looks like new after 750 plate appearances. You get the joke. That's because the bat never actually makes contact with the ball. You are looking for a location for the company to lease or build a warehouse from which the company will ship bats to sporting goods states. I guess I've already gone over this one, haven't I? Would you prefer to rent space in a throwback state or a non-throwback state? Well, duh. Why would anybody ever put a warehouse in a throwback state? So, with me? Okay, so you wouldn't do that. You would put your warehouse, you want to ship from a state that does not have a throwback rule. 70. Consolidated Lint ships 5,000 tons of lint to the U.S. Army for use in an experimental lint bomb. The lint is shipped from Pennsylvania to the Aberdeen Proving Grounds in Maryland. If Pennsylvania and Maryland both adopt UDITPA, to which of these two states is the sale included in the numerator? Well, you would think if they're shipping from Pennsylvania to Maryland, under all of these rules that I've just said, you would think, well, destination would be the place. Except that sales to the U.S. government have a special rule. Sales to the U.S. government, and the U.S. Army is part of the U.S. government, are sourced to where the goods are shipped from and not where the goods are shipped to. Why is this the rule? Well, there has been various logic has been expressed for this rule, saying that shipments to the government might be distorted if we put them in a particular state, although that doesn't make sense because the government is everywhere, right? So they're always taking delivery of things. I've heard somebody once say that this may have had something to do with national security, that they didn't want foreign countries to understand where we're shipping defense goods to, but that doesn't seem to make a whole lot of sense either. So I don't know what the logic of this rule is, but you know I won't be able to resist testing it. So circle 70, shipments to the US government are never sourced on destination. They're sourced on where you ship from, okay? At least under the UDITPA rules. You know, again, whether states have adopted that particular rule, I don't know, but okay, 71. STX prepares market analysis surveys from its offices in State Pink. It signs a contract to provide services to a company domiciled in State Brown. If Pink and Brown both adopt UDITPA, to which of these two states is the sale included in the numerator? I gotta change this. This is torture to read. And I wrote it. In which the two states is the sale included in the numerator of CL's receipts factor? Well, under UDITPA, and I would say that this has generally been the law up until recently among the 50 states. When you perform services, typically their sales are sourced. The income from the sales are sourced in the state where the service was performed. So in this particular instance, it's entirely performed in State Pink. So under the old cost of performance rules, all of the costs were incurred in performing the service in State Pink. Therefore, all of the revenue is in State Pink. All right, now we got a tougher one. 72. Same as the last question, except that the work is carried on within several offices of the STX Corporation. The work is performed 40% in Alabama, 25% in Mississippi, 24% in Pennsylvania, 11% in Connecticut. If Alabama and Mississippi both adopt UDIPA, in which of these two states is the $50,000 included in the numerator? Well, looking at the rule, and we look at 17A, I'm going to go look at it myself. Okay. Sales other than the sales of tangible personal property, so that would include a service, are in the state if the income producing activity is performed in the state, or the income producing activity is performed both in and outside of the state, and the greater proportion of the income producing activity is performed in this state relative to any other state. Okay. So basically what UDIPTA has is an all or nothing rule on the cost of performance. So these being the percentages, how much of the income would Alabama pick up? So they made $1 million on this particular service that they performed. Alabama would get 100%. Under the UDIPTA rule, whoever did the most gets all of the income. So to answer my first question, Alabama would get 100%, Mississippi would get 0%. Okay, so this is called the plurality rule. That's the shorthand for this rule, where they're saying, okay, the state that did the most gets all of the revenue. I would say up until about 3 years ago, almost all the states had that rule. It's changed a lot in the last few years. All right. Let's move on. And keep looking at those percentages. Number 73. Same as the last question, except that Pennsylvania does not follow UDIPTA and instead uses a proportionate cost of performance rule and not UDIPTA's preponderance test. How much of the now it's 50,000. Okay. How much of the $50,000 sale is included in the numerator of Pennsylvania's receipts factor? Well, so Alabama and Mississippi are using the preponderance test. Pennsylvania is using the proportionate test. So here it would be, we're going to pick up, if it's $50,000 is the receipt, then 24% of the $50,000 will be sourced and included in the Pennsylvania receipts numerator. Okay, 24% would be sourced to Pennsylvania. We have an issue, right? How much did we source to Alabama? 100%. How much did we source to Pennsylvania? 24%. Oh, we have numerator inclusion of 124% of $50,000. Is this a problem? No. These are all constitutionally, this is all allowed, right? This is all allowable. This is all of these rules are internally consistent. It's just that when you compare the different methods, it gets a little, it allows for double taxation. I want you to circle 73 because when I ask this question, notice I didn't say if, when I ask this question on the final, this is not an answer that you can get out of the UDIPTA, but I thought it's really worthwhile knowing, okay, and I think you need to know about this, that some states use the proportionate rule on services, while other states use the preponderance test. Okay, with me? Before. Okay, 74. STX prepares a new report for the New York Times. The work is performed 30% by the company's New Jersey employees, 20% by the company's Pennsylvania employees, 25% by the company's California employees, and 25% by Jones Corporation working as a subcontractor for STX. Ah, so now we got a mixture of things going on. We have most of the work being done by employees. Some of the work is being done by subcontractors. Jones Corporation is located entirely within New Jersey. New Jersey used, I should say, I got to update this. New Jersey no longer uses this. New Jersey uses the proportionate test, but includes the contributions of subcontractors in their formula. How much of the $100,000 fee will be included in the numerator of STX's receipts factor? All right, so this is yet another variation on the rule. Virtually all of the states that use the cost of performance approach only look to employees. Certainly, the UDIPTA only looked to employees. However, real world, some states, actually, to be honest with you, I think it was only one, and it was New Jersey. Maybe something, I'm racking my brain. There was another one, but New Jersey had you include subcontractors or contractors or subcontractors in calculating what percentage of the work was done in New Jersey. So that was sort of like a New Jerseyism. Now, by the way, New Jersey has abandoned cost of performance and adopted a completely different approach for 2019, starting in 2019. And the rules, the implementing rules only came out, I think, on March 15th. And I had to, someone was prepared, well, I'll tell you what, I don't want to confuse everybody, but these new market rules, which are basically where is the customer located, except that it's much more complicated than that. It's where did the customer receive the benefit of the service that you provided. Now, for companies that have thousands of customers, I'm not quite sure how they're supposed to sit down and figure out where all of their customers enjoyed what they did. That seems like almost an impossible burden to be putting on companies. But it has produced, the rules that they produced were so vague. I was explaining to someone for about 2 hours today. The rules are so vague that you can pretty much come up with whatever answer you want. They said, oh, that's great. I said, well, not really, because the government is also free to come up with whatever answer they want. So basically what you need to do here is apply for a ruling with the government. So because if you choose the 5% route and the government chooses the 13% route, you're going to be in a world of hurt later on. So anyway, I'm moving so far afield that I should stop. All right. So what I'm telling you here, all this cost of performance has radically changed over the last few years as states are adopting a market type philosophy on services. 75. Same as the last question, except that instead of working for the New York Times, the report was prepared for the Chicago Tribune. Illinois, oh, now I'm really being cruel. All right, Illinois sources receipts on a market basis or to the primary location of a service provider's customer. How much of the $100,000 fee will be included in STX's New Jersey receipts factor numerator, and how much will be included in STX's Illinois factor numerator? And I think I wrote, as judging by the years, I wrote this back in 2013 when Illinois' approach was rather unique, that when they were using a market approach rather than a customer approach. I think that's why I used Illinois. Now a lot of people are using it. But anyway, so to go back now, we would be 55% New Jersey, right? As we picked out in the previous question, right? I'm not sure I actually went through the numbers with you before, but in the answer to 74, maybe I should go back to 74 for a second. So as I mentioned, New Jersey was unique. They included subcontractors in their formula. So if 30% was done by their own employees in New Jersey and 25% was done by their own subcontractors, then it would be 55%. You would add them together. You would be 55% New Jersey. Okay, 75, number 75. In this case, we continue to be 75% New Jersey, but we're also 100% Illinois, because Illinois is saying, well, who bought the service? Not who provided the service, who bought the service? My answer to 75 is, don't let this happen to you, okay? This is the mission of the state planner, is to understand who's got the throwback rule, who doesn't have who has the market rules. If they have a cost of performance rule, which is the proportionate cost of performance rule. I want you to circle in your notes, as I mentioned before, 73, 74, 75. Okay. Now, on the final, I'm not going to ask you a question with New Jersey. I'm going to tell you that State Brown uses the proportionate cost of performance, or State Gray uses the market approach. And then there'll be a set of numbers, and you tell me what the receipts, well, I'll tell you what the receipt, and you have to say whether that's correct or incorrect, right? True or false. So, okay, so I want you on this very simplistic level to know what the market rule is, what is the cost of performance, what is the proportionate cost of performance, what is the preponderance cost of performance. That's all fair game, okay, for the final. Okay, so again, to sort of repeat, well, certainly for the sale of goods, know the throwback rule, right? That's right in the rules. I want you to know the preponderance test, which is just UDIPTA, right? The UDIPTA rules say whoever contributes the most gets all of the receipt. I want you to know the cost of performance preponderance test. I'm sorry, proportionate test. I want you to know the cost of performance subcontractor rule. Right, no, okay. Know that, and then know the market rule, simply that in that instance, we source to where the customer is located. Now, I'm not going to, let me just mention to you that market-based sourcing, you think it sounds easy. You're going to base to where your customer is located. It is the most complicated thing in the world. This has become the trend over the last 2-3 years, is that companies are going to market sourcing, and states are going to market sourcing, not companies. So, and the rules, it's funny, New York adopted it in 2015, and they're only now putting out the regulations. And the regulations are about 100 pages long on how they have every conceivable type of service that you could be providing, how a movie company should do it, how a cargo ship company should do it, how airplanes should do it. California adopted this. They also put about 100 pages of regulations. New Jersey adopted this in California adopted it in 2012, New York in 2015. New Jersey adopted it last year in 2018, effective for 2019. And everybody's been waiting for their 100 pages of rules. And you would think they can look at California's rules and copy them. They could look at New York's rules and copy them. Or they can make some numbskull attempt to come up with their own rules. And guess which one, guess which option they picked? Then they decided to come up with their own rules, and they're only like 5 pages long. And if you can imagine, if New York devoted 100 pages to it, there must be something missing in New Jersey if they only adopted about 5 pages of rules. It is a litigator's wet dream come true. This is going to produce so much litigation. that it makes me sad to think that I'll be retiring at the end of this year and missing this cornucopia of future revenue source. But that seems to be, it's funny. The government closes down. I remember the tax commissioner of New Jersey mentioned to me, well, as soon as we adopt combined reporting, a lot of our issues are going to go away. I said, no, it's going to get more complicated. And plus you're adopting market sourcing at the same time. This is, you think you close down the tax court? You better hire 10 more judges. So, because, all of this stuff is interpretive and it requires, different people interpret different ways. My favorite saying on interpretation is simple. You're born, you die, everything in the middle is subject to interpretation. And that's the way I approach life. Anytime people write a set of rules, different people will interpret them differently. The government will interpret them differently than taxpayers. Taxpayers will take the interpretation that lowers the tax. The government will take the interpretation that increases the tax. And of course, that's what lawyers are for, is to figure out, 2 lawyers and a judge make a lot of money. Not the judge, the 2 lawyers. Okay. I see that it's been so quiet that I've been wondering, is everybody still there? Yes, 78 people are online. Okay. Cool. All right. All right, so 75 is that don't let this happen to you. All right, 76. If STX performed 250 different, okay, time check. If STX performed 250 different contracts in 2013, does it compute its proportionate cost of performance invoice by invoice or by examining all transactions in the aggregate? Well, isn't that the $65 bazillion question? And quite honestly, no one ever knew the answer to that question, even notwithstanding the fact that cost of performance was around from 1957 till a few years ago. Nobody ever gave instructions on how you were supposed to do it. You were literally supposed to look at which people in your company serviced contract A, which people served contract B. It was never really spelled out. So for 76, I wrote, this is largely unknown, a great planning tool for the unlazy tax planner. Am I? Oh no, okay, I can't be done. Why am I missing pages? I'm sorry, bear with me for a second. There's still some more questions, aren't there, on the outline? Somebody speak up.
No.
Is 76 the last question?
Yes.
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 I didn't do this right. There's a couple more questions that I know, that I remember. That is so cute. Join our class. Why am I missing? All right. The one subject that I had left, I'm going to do this from memory, was, and I guess we'll tackle it. We'll come back to this on the next class. I think I skipped 1 and 2 questions, so I inadvertently didn't include them in the package, was the subject of distortion. What happens when, for any variety of reasons, you're not happy with the result of the apportionment? Now, you'll recall that when we talked about this constitutionally, there wasn't a lot of room as a constitutional mandate. Remember, there was the Hans Rees case, but that was highly unlikely. And as the book ended up concluding, as a it is very difficult to get a deviation from the normal apportionment rule. Only in an extreme case like Hans Rees, it was allowed. And you'll also remember in British land, it sort of was allowed. But as Hellestein pointed out, I would not take on contingency a case dealing that as a constitutional matter, I'm entitled to alternative apportionment. Well, that ain't the case in UDIPTA. And why am I, all right. That is not the case in UDIPTA. And why is that not the case? And all right. Okay, go to section 18. And it says, I'll sort of read it out loud. If the allocation and apportionment provisions of this act do not fairly represent the extent to the taxpayer's business activity in this state, the taxpayer may petition for, or the tax administrator, so both the government and the taxpayer can petition for alternative apportionment. And how might that be done? Well, maybe we'll substitute separate accounting, or maybe we'll exclude one of the three factors, or maybe we'll exclude two of the three factors, or maybe we'll add factors. Maybe instead of using three factors, we'll use five factors. And then the employment of any other method to effectuate an equitable allocation and apportionment of the taxpayer's income. And so basically, this is a section that I guess can just be called a general grant of equity to the government and to taxpayers to say, hey, I don't like the three-factor answer. I'm going to petition for something different, or the government can petition for something different. Of the last 500 cases I've settled with the various states, primarily New York State, New York City, and New Jersey, almost all of them came down to some application of special apportionment, or using these rules. I would say, hey, these rules are producing an absurd result. It's not fair. I have evidence that you're overtaxing us, and the government will say, we have evidence that we're undertaxing you, and this is a free-for-all, where it's basically make up your own formula. And don't think this is a rarity. This is how almost all tax disputes get resolved, is by some sort of separate accounting. Just today, I was talking to the state, and they said, all right, file a petition. In New Jersey, it's called Section 8 relief. File a petition for Section 8 relief. And that's where that's this section. Instead of 18, it's Section 8 in New Jersey, so they call it Section 8. There was a case in the book, which I'm trying to remember. I'm never going to recall it now, but I'm kind of recalling. I'm sort of, from memory, I'm remembering the final question, and I don't know how I got that cut off. The question I had come up with was, let me think for a second, is, I'm going to mess this up. Okay, all right. So a company, it was a funny story I made up, where a company was in really bad shape, all right? And they're losing their shirt. And then what do? They hire, who buys the company? Warren Buffett, the sage of Omaha, right? Probably one of the great business, even though he's like 90 years old, he's one of the great businessmen in US history. and he takes the job of turning this company around for $1 a year because he's already worth billions. What does he need a salary for? So he takes over the company, and the company goes from losing millions to making billions the next year. Okay, so the company has a complete turnaround, and Buffett, who lives in Nebraska, he lives in Omaha, Nebraska, he's only being paid $1 a year. And I would have said, and the gist of my question was, could Nebraska ask for alternative apportionment, saying that, hey, Buffett, a genius like Buffett should be paid, should be paid 30 billion a year and not $1. So perhaps your payroll factor for Nebraska is understated because Buffett isn't taking a salary. And I would say that would be probably a good reason why Section 18 of UDIPTA might get called into application, right? There's something there. There's here you have a raving genius, and his income is his contribution to the company is not being considered. Okay, so that would probably be a great application of Section 18. But I'll tell you what, I think I had 1 or 2 questions on that. I'm sorry, I apologize that I edited it out of this. So sorry. But we'll get to it. We'll come back to it next time. All right, we're done temporarily. We'll come back to it next week, but we're temporarily done with income tax. So let's talk about sales tax a little bit. And boy, I think I got through that a lot faster than I thought I would. So it's only 8:25. Maybe we'll do more sales tax than I was anticipating, but give me 2 seconds to get organized here. Here it is. Okay, so chapter 8 is sales taxes. And I think you're all familiar with it. You go to the store, you buy something, they charge you sales tax, right? The sales tax originated back in the 1930s during the Depression. Why? We may see, who knows, they may resort to this big time next year. During the Depression, no one had any income. There was no, so income taxes weren't collecting a lot of income. So they resorted instead to a sales tax. By the way, all right, already I'm going to deviate a little bit from my planned remarks and just tell you about something I heard earlier today. So I have been, in addition to working about 10 hours a day, I seem to spend about 5 hours a day talking about the crisis and that's going on and listening to various things that are going on. Anyway, guess what percentage, well, as you may know, Florida doesn't have an income tax. Florida does not have an estate tax, notwithstanding that half the people that die in this country live in Florida, right? That's a big old age community. That's what Florida's got. 2 huge things going for it: tourists and Social Security checks, right? Social Security sends billions of dollars to Florida every month, and zillions of tourists show up in Florida. If you want to tax tourists, what do you tax? That's easy. You tax hotel rooms and you tax rent-a-cars. If you go stay in Florida, if you go stay in a hotel anywhere, and you said, but gee, the advertised rate was $100, but you're charging me $180. Why is that? Well, look at your bill. Okay, the county is asserted a tax, the village is asserted a tax, the state is asserted a tax. Before you know it, your sales tax on your hotel bill, it could be like 80%, right? It's $100 for the room and $80 for the government. And same thing with rent-a-cars. While sales taxes are normally 6, 7, 8, 9%, sales taxes there are special rates for rental cars typically in these high tourist states. So it's not, I think in Florida, to rent a car, it's like an 18% sales tax, something crazy like that. So Florida has, thus being not having an income tax and not having an estate tax, something, it was crazy. 78% of the state's budget is raised by sales taxes. And guess what? So it's all paid by tourists. There are a lot of tourists in Florida these days? No, right? The beaches are closed. The Disney World is closed. Universal Park is closed. Everything is closed. No one is, by the way, I just saw, the quarterback of LSU was the first pick in the draft. All right, good. The NFL draft is tonight. That's, so anyway, all right, so Florida's got a problem now because they put all their eggs in the sales tax basket, and now it's not paying off at all. So that's not my problem. It's Florida's problem. All right, so the idea of the sales tax as it was created in the 1930s was to have a consumption level tax only. Well, what does that mean? Well, it's only supposed to apply at the retail level of transactions. So as you may know, supply chains are a complicated thing, right? Something may be manufactured in China and then it's sold to wholesaler A in the US, and then wholesaler A sells it to wholesaler B, and wholesaler B sells it to wholesaler C, and then C sells it to the store, and then the store sells it to you. Of course, I'm telling you how things worked last year. Now, of course, it's somebody sells it to Amazon, and then Amazon sells it to you. It's a more abbreviated supply chain. Okay, I'm sorry, I'm getting all these interesting emails as we speak. I keep getting distracted to them. So now the thing about the sales tax is that it only applies to the last level of sales. So a good or a widget could be sold several times before it gets to you, the final person. You're the only person who pays sales tax. All of the wholesale levels of transactions are not subject to sales tax. Those people are granted an exemption, and how the mechanics of that exemption works is part of Chapter 8. So what this avoids, and I'm sorry, this is, and see, this is very significantly different from a value-added tax that most of the rest of the world uses. Of that, a tax is imposed at every single level. So if wholesaler A sells to B, and B sells to C, and C sells to you, the consumer, there's a tax levied at each step of the way. And that's why a VAT is a very, very consumption-oriented tax, because basically you're paying tax on tax on tax. What do I mean by that? Okay. Wholesaler A buys it from the manufacturer. He buys it for $100, but he pays a $10 value-added tax. So now his costs, he's got to recover that $10. So he sells it for even more money to B, right? He's got to cover it. So B pays a VAT tax. So now there's been two levels of tax. That gets built into the price. And the VAT that guy pays, that gets built into the price. So by the time the consumer gets something, there's been a colossal amount of VAT tax asserted against objects. You'll realize this if you ever go to Europe and you go to a store to buy something, and all of a sudden they start ringing up these colossal things. Are so much more expensive than they are in the US, right? In the US, you only have to add on, say, 8-9% for the sales tax. There, it's a whole complicated process. What's noteworthy is that if you're American in Europe, you get, if you're willing to fill out a lot of paperwork, you get your VAT tax refunded to you at the airport as you're leaving the country. An interesting little side point. Okay, so that's what's known as the pyramid, that the fact that there's tax on tax on tax. In theory, there's no pyramiding of tax under the sales tax regime because, right, on individual items, right, it's only the tax isn't paid by the wholesalers, only paid by the final customer. But in reality, there is pyramiding because it's not a perfect system. Oh, it looks cute. The dog is like on my shoulder. The what we don't have in the US and what Hellerstein spends a lot of time in the book discussing is that he thinks the system should work differently. He thinks that businesses should not have to pay a sales tax because he's saying that there should be no sales tax on any business inputs, but there are. So let me explain to this how this comes to be. So you walk into a McDonald's and you buy a hamburger. All right. So is there sales tax? Yes. Okay. But so when McDonald's buys the food to sell to you, they don't pay a sales tax, right? So that you would think there's no pyramiding. But if you walk into the McDonald's bathroom and there's paper towels there, did McDonald's buy those paper towels with the thought of reselling them? No, they're the final consumer. They're considered to be the retail consumer for the paper towels. So they pay a sales tax on those paper towels. Now, of course, McDonald's is in business to make money. How do they recover all the sales tax that they pay on their paper towels? They charge more for your Big Mac, right? So essentially, there's really no getting away from it. There is, to some degree, a minor amount of pyramiding in the US. That is nothing, however, compared to a value-added tax, where there's just a huge tax asserted at every level of the process. Now, people have always attacked the sales tax as being regressive. How so? Well, the income tax is considered to be progressive, right? Because there's income tax brackets. If you make $10,000 a year, you pay a very small amount of tax. If you make $100,000, you pay a higher percentage. If you make, $1 million a year, you're at the highest percentages, right? So it's progressive. Rich people pay more. By contrast, the sales tax only has one rate to it. So it's considered to be regressive. And what's more, remember, sales tax is a tax on spending money, and income tax is a tax on earning money. So you would think it's regressive in the sense of rich people. Do they spend all their money? No. They make money and they put a lot of it in the bank. On the other hand, poor people tend to spend all of their money, whereas rich people don't spend all of their money. So it's thought, whoa, even though it's the same rate, it seems to impact the poor a lot more than it does the rich. So, but quite honestly, that's not really the case. And let me explain this, because there are so many different exceptions for the sales tax. For example, do you normally pay a sales tax on food? No, you don't. Of course, the rules vary among the 50 states, but you don't typically pay sales tax on food. If you go to McDonald's, you pay sales tax because that's not food, that's a meal, right? A provided meal in a restaurant is different. But food, when you go to the supermarket, is exempt from tax. Do you pay sales tax on rent? No, the rent you pay on your apartment, there's no tax. And on clothes. Well, clothes is a little bit different, a little unusual, because cheap clothes, there's no tax. But once you buy a more pricey item, there is a sales tax on clothes. I forgot what the breakdown is. Growing up, I recall that there was New York applied a sales tax to all clothes, whereas New Jersey did not. So, of course, there was a rule in the Korman household that no one was allowed to buy clothes in New York, and that a few times a year we would drive over to New Jersey and buy all our clothes. Like, imagine in the middle of the summer we were looking for our winter coats, because we could avoid paying the sales tax on it. Did we owe a New York use tax? Of course. But did my dad pay it? No, of course not. So recently, there have been federal proposals to get rid of the income tax and adopt a federal sales tax. And and this has got to be one of the great scandals of all time. People are thinking it's going to work just the way the state works, where you'll be paying tax on books and televisions, but not on food, clothing, and rent. Well, that's where people are wrong. These federal proposals to raise anywhere near the amount of money that the United States needs to raise, it's going to be applied. Not only is it going to be applied to everything, like buying a house or paying your rent, but it would also apply at every level. So it would be like it would actually be more like a value-added tax. That is unlikely to ever happen, or it probably won't happen until my generation kicks the bucket, because basically we've been paying income taxes all our lives. If they now want to switch to a consumption level tax, I think we would probably be motivated to total revolution at that point. So it's unlikely to ever happen. And think about it for a second. The income tax provides a huge subsidy to housing in this country, right? Property taxes are deductible. Interest that you pay on your mortgage is deductible. It's a huge subsidy that the government pays to support the housing industry. If suddenly you remove that and you went to a consumption level tax where all of your mortgage payments were subject to some sort of a tax, well, then that would completely undermine the value of real estate, and you would have some sort of a crisis on your hands. So any transition, not that you don't have a crisis nowadays anyway, but any transition from an income tax to a consumption tax would probably have to take place over a considerable period of years. So, all right, so that's my background on the sales tax. So let's talk now a little bit about basic vocabulary. There's a lot more unity among the states on the sales tax. To be honest with you, I don't know that anybody ever passed a model sales tax act that they all copied, but for the most part, you know, one sales tax, you know them all. Except that each state, of course, has important exceptions, right? Different states tax different things. And in New York, if you live in New York City, it's particularly interesting in that the state taxes certain things and the city doesn't, and vice versa. So occasionally you'll go to the store and you'll buy something and you'll only pay a 4% tax instead of what the usual rate is. And it's invariably the reason is because the state tax and the city doesn't, or vice versa. So it is complicated from that sense, but the basic structure of the sales tax is fairly consistent among the states. So, although, of course, on the outline I've created for Chapter 8, I get into all of the reasons, all of the different little areas, all the little nitty-picky things where there's a disparity of treatment among the states. So sort of alert you to that. I thought some basic vocabulary is always important. I think I've mentioned this before. Whenever you look at a new law, the first thing you should look at is the basic vocabulary. Because if you don't know the vocabulary, you don't know what you're reading. You might think of things differently than the way the government intends. So you always have to understand how things are defined. The word person is very important because in sales taxes apply basically to everybody. It applies to individuals, it applies to corporations, it applies to partnerships. And if you look at the basic definition of person, it includes everything. It includes living beings, and it includes just about any type of business entity that is cognizable at law. So like trusts, partnerships, limited partnerships, corporations, those are all things that the law gives birth to. So all of these things, well, anything capable of buying something, and that's all wrapped up in the definition of purchase. Well, the person is, think of it as just the buyer, okay? So you have to understand when they're referring to person, they're referring to anybody with money that could buy something. Of course, there are exceptions. There are going to be entities that are exempt from the sales tax, but that's going to be a special section that says, okay, the following entities are not included within the definition of person. All right. So by person, we mean buyer. All right. A purchase at retail. All right. So that means the final purchase. That means the purchase by a person or a person who is the consumer. The consumer is the person who's going to actually use it, not the person in the chain of title. That sort of, wholesaler to wholesaler. That's not a purchase at retailer. Only the final consumer is the person making a retail sale or a purchase at retail. A purchase means a person to whom a sale of personal property, I should say, insert the word tangible before personal property. So means a person to whom a sale of tangible personal property is made or to whom a service is furnished. Typically, the sales and use tax applies to the purchase of tangible personal property, although more recently, services have become included in what is subject to the sales tax. The general rule of thumb is that all tangible personal property is taxable unless exempted, whereas no service is taxable unless it's included. So, so there is no general sales tax on services, only certain services, but we'll get to that. All right, what is a receipt? That's the amount of money that's collected when an item is sold. All right, so you sell an item of tangible personal property, receipt is the amount of money. It's the sales price. Okay, a retail sale is basically the same as the purchase at retail. And here are two key definitions, or three. All right, the retail sale is the final sale. It's the one that's taxable. It includes any sale, lease, or rental for any purpose other than for resale, sublease, or subrent. Right? If you're buying to sublet, then you're not the final user. Sale for resale is Sale for resale is an exempt transaction. That is, as I described before, wholesaler A to wholesaler B or wholesaler B to C. That is a sale for resale. That is exempt from the sales tax. That is the term of art they come up with a non-taxable sale. And finally, we keep using the words selling. Oh, there's more. I'm sorry. This is your key event. Sale, selling, or purchase, right? You can't have a retail sale unless you have a sale or you have a purchase. So what does that mean? Well, it means the transfer of title. Title means ownership or possession. What does possession mean? Means you're holding something, right? It's in your possession. The transfer, you don't need the transfer of both title and possession. You only need one of them. So it's title or possession, which is going to become the taxable event. Okay. So it's transfer of title or possession or both, exchange of or barter, rental, lease, or license to use, consume, conditional or otherwise, in any manner, blah, 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 including the rendering of any service taxable under the Act. So notice it applies to all transfers of title or possession of tangible personal property, although later on there's exemptions, but when it comes to services, only certain services that the Act itself says are taxable. Tangible personal property. We've done this before. This is remember there's two types of property. There's real property and there's tangible property, right? And tangible personal property means any property that is perceptible to the senses. So it can be seen, it can be heard, it can be weighed, it can be touched, it can be felt, and all of those things. That's your basic definition of tangible personal property. And I'm going to skip the other definitions for now. We'll come back to them later. Okay, so I've given you some key definitions. So let's go to some questions, sort of testing what you've learned so far. So question 1, seller, that's S, right, sells Blackacre to B. In law school, Blackacre was always a piece of land. They always give it a name. So seller sells Blackacre to B for $20,000. Sales tax due? Anybody want to volunteer? We're selling some real estate. No brave people. Anybody listening? Is that taxable? Well, no, because why? It's real property. Real property is not subject to the sales tax. Okay, number 2, S sells the www.widgets.com domain name to B for $1 million. Taxable? Well, no, because only some services and tangible personal property. Is this tangible personal property? No, it's intangible personal property, right? A domain name, you can't see it or feel it or taste it. It's not perceptible to the senses. Okay, 3. S, a utility sells $100 of electricity to B for use lighting B's home. Sales tax due? So in other words, the sales tax due on electricity. So basically, what is the basic underlying question here? Is electricity tangible personal property? What do we think? Anybody want to volunteer? Brave person? Anybody? Phil with 2 L's, I see you here. What do you think? Taxable or not taxable? The sale of electricity. Is it tangible personal property?
If you're selling electrical equipment, then I guess it could be
No,
considered.
not equipment. Equipment is obviously tangible personal property. I'm saying you get your Con Ed bill. Do they charge you sales tax? And don't cheat by running for your Con Ed bill to tell me if they charge you sales tax. What do you think? Is electricity tangible personal property?
No.
Yes.
Which one? Phil, was that somebody else?
That was Alpha.
That was Alpha? Okay. Alpha, you are correct. Because can you see electricity?
I saw it on my bills.
You see it on you're cheated. You looked at your bill. Okay. So it's,
No, I remember.
but why is it tangible personal property? Can you see it? Can you see
Oh, because
electricity?
We don't see, but we see the
Can you-
effect. We see the light.
Well, you can see the light, but that's the manifestation of it.
Is
But
it a meter?
can you see it? Can you touch it?
No.
Well, I actually just gave away the joke, right? You can't see it, you can't hear it, but well, there's an outlet down there. If I stuck my finger in it, what would happen? Would I feel it? Yeah, I would feel that, right?
Yes.
Think of the guy years ago that they used to at Sing Sing strap into old Sparky. Was he about to feel something? Yep. So the courts have determined this has been tried in court. The courts have determined that electricity is tangible personal property. Because while you can't see it, you can certainly feel it. I've actually seen all kinds of strange cases where they get into, well, electricity has weight. It's like, you know, it has measurable weight and all that. But it seems to me that's like overkill. The fact that if you stuck your finger in the socket, you would feel it. That clinches the deal as far as I'm concerned. Okay, number 4. S, a furniture manufacturer sells 300 tables to B, a furniture store. Sales tax due? Anybody? I'm just looking at names that I see on my, I can't keep going back to Philip with 2 L's. So,
No,
no, okay, thank you. It wouldn't be taxable. Why? Because it's a what?
because that's not the final consumer.
It's not the final sale, which means it's what? It's a sale for
Resale.
It's a sale for, right, it's a sale for resale, so it can't be subject to tax. Okay, number 5. S, the furniture store in the previous question resells 10 tables to another furniture store. Retail, is this taxable? So one furniture store sells it to another furniture store.
No.
Not
No,
taxable,
business to
not a,
business.
right, not a retail sale. This is a sale for resale, it's exempt. 6, a furniture store sells a table to B, an individual in the need of a new dinette set in his home. Sales tax due?
Yes.
This is the right. This is the retail sale. This is taxable. Okay, number 7. S, who was B in the previous example, sells the dinette set 5 years later at a garage sale. Taxable?
No.
Yes.
You're
No.
both right. We got a no and a yes, and you're both right, because that's going to depend upon whether or not a state taxes so-called casual or isolated sales. The general rule is that it would be taxable. Of course, who does it, right? But
Professor, I have a question.
yeah.
What about if the retail sell it to a restaurant?
Say it again. You sell, who
What
sells?
about if the retail store sell the table to a restaurant?
Well, the restaurant is the final user, right? They're not reselling the
Okay.
table. So I would say that's a taxable event. That gets
Okay.
back to my pyramiding issue before, right? Even though a restaurant is a business, they pay sales taxes. They don't pay sales tax on food because they're going to resell it. They don't, but they pretty much pay, they pay sales tax on their tables, their chairs, the toilet paper in the men's room, all of that stuff they pay. They're the final user of, right?
Okay.
So all of that sales tax gets passed on to you. I'm starting to wonder if I'm ever going to sit down in a restaurant again, but all right. So 7 is a little ambiguous, right? Because that's a special category, the so-called casual or isolated sale. See, now remember, the sales tax gets enforced at the store level, right? It's easy for the government to go in and audit this to make sure that they're charging a sales tax, right? And of course, the store collects the sales tax, right? And then remits it every week. They remit it to the government. So that's the way they enforce it. They're not particularly interested in making sure that people selling, I sell you something from my garage, that I collect the tax on it. How much am I going to collect? $20? It's not really worth it for them. It's on the law, but it's in the law, but it's probably a not very enforced part of the law. Okay, number 8. S, the owner of a hardware store gifts $100 of electric wiring to his son. Sales tax due?
No.
No.
Well, you would think that's conventional thought with sales tax would not be due because on the transaction with the son, because there's no purchase price, right? The tax is levied against the purchase price. But what about when S, the owner of the hardware store, bought it? Did he pay sales tax?
Yes.
No, because he wasn't the final user, right? He didn't pay sales tax because he said, I'm going to resell it. But did he resell this? No. So S, the owner of the store, should go back and remit tax on that $100 because he unfairly didn't pay tax on it, right? So his purchase of it became taxable. With me on that? His purchase became tax. It was no longer a sale for resale, or purchase for resale. Okay. Number 9. Does your answer to number 6, which one was number 6? Oh, okay. Change if instead of selling the table to B, S leases the table for 3 years to B. And the answer here is yes, it's due, because this cuts to the question of, earlier we discussed what's a sale, or I think, wait, let me get the term of art. What is a sale or selling or purchase? And I said that it was either a transfer of title or possession or both. So you don't need both, you only need one. When you lease property, you're not selling it, but the lessee is acquiring what? He's acquiring possession, right? He's exercising, as I say, dominion and control over it. So that is considered to be a transfer of possession, and a transfer of possession is just as taxable as the outright sale of title. All right, so let's move into a tricky area. And so we'll only do one tricky area tonight, and then so we're sort of at the we're within 10 minutes of finishing off for the night. So sometimes it is difficult to distinguish tangible personal property from a service. How so? All right, well, number 10. Seller is a commercial artist selling a drawing to a newspaper that will use it to illustrate an article. The drawing is sold for $1,000 and was drawn on sketch paper that retails for 50 cents. Is this is sales tax on $1,000 due on this transaction? This is a case that's in the book, the Washington Times Herald case. And the case gets resolved. It's like an old case. It's like ancient history already. It's like from the 1950s or 60s. And the court ends up concluding, well, the court ends up looking at this, and they're saying, what was the item of tangibility here? Well, the tangible item was the paper itself, right? And the paper was worth 50 cents. But the drawing was worth $1,000, right? Because it was a great piece of art, right? It was really, you know, a great piece of art. So what are you buying here? Are you buying the guy's service? Now, artistic services are not subject, are not one of the services that are taxed. So if you look at this as you commissioned a work of art, that's a service, right? But necessarily the piece of art has to have some sort of physical manifestation to it. So he drew it on paper. So is that piece of paper now worth $1,000 rather than 50 cents? If you think about it, if we're going to apply the tax to the $1,000, we're essentially taxing a service. So this is one of the basic conundrums of sales taxes, is when services, when a piece of property otherwise worth some nominal amount of money suddenly gets enhanced by services, does the tangible property become more valuable, and is it subject to tax? Now, in this case, it's sort of in the book because it's not a very well thought out case. And basically, all they resolve in the case is that they do a relative value test, and they go, they're basically thinking, well, I think the tangible property, the tangible aspect of it ought to be worth at least 10% of the total value of the item. So here, it's only 50 cents versus 1,000. Okay, that's not 10%. So they're deciding that it's exempt. They don't really do any more type of a sophisticated examination of it. So they don't, let's see. So I made some interesting notes here. So under the court's test, would the sale of a Rembrandt for $100 million, you know, famous artist, be free of sales taxes? Well, what would the case be? I guess you would have to go back 500 years and figure out how much did Rembrandt pay for the paint, right? And the canvas that he painted on. So probably a couple of dollars, right? And then, but the Rembrandt, of course, today is worth $100 million. So should sales tax apply in this instance? Well, I think in our gut, we think yes, it should be, right? Because this is, if this is subject to sales tax, what shouldn't be, right? A famous work of art. Under the court's test, though, because the value of the materials is so inconsequential compared to the final value of the painting, it's going to be exempt from taxation under this court's test, which makes no practical sense at all. So here we think about it a little bit differently, right? So, all right, so this was your basic state of affairs. Now, the learning tree case in the book is one of those cases that you love, because it's the same exact issue comes up, same exact issue, and the court decides to examine every single possible way of trying to figure out this particular dilemma. And they look at every theory that's out there, and they come up with various sort of ways of looking at it. So I'm sorry, I just want to I just realized I'm missing some of my notes. I knew I should have spent 5 minutes preparing in the last week. You know what? I may have to call it a night because I'm missing some crucial notes that I need where they compare, where in that case, they compare all of the different tests that, all of the different ways that it can be looked at. I'll mention one of them. No, it doesn't make sense to mention one. And then, all right, so I'll tell you what. Learning tree is a case that you really have to, if you ever read a case, it's easy reading. All of the entire sales tax chapter is very easy reading. It's all in plain English. It's not constitutional. It's all easy shit. It's all good stuff. And in Learning Tree, it's fantastic because they lay out like about 6 different tests, so 6 different ways, and then finally they decide which is the best one which is the one that Colorado should adopt. So I need to reread the Learning Tree case. And in addition to you, I'd like you to read that. And then next week we will start here. Okay, I will be I failed you. I was not prepared. And maybe I'm also getting exhausted because I've been working since like 7 a.m. this morning. So how about we pick it up here next week? Read Learning Tree. It's really worthwhile. It's a really interesting case. And we'll go through about 5 or 6 different ways of analyzing this very fundamental question of a 5-cent sheet of paper, but on it is all sorts of expensive things, all sorts of valuable things, such as blueprints, right? The blueprints or the patent blueprints to a jet fighter is probably a very valuable piece of things to have, right? Is that tangible or is that intangible? Should that be taxed or not be taxed? We will find out that California has a very interesting way of looking at this question. In fact, that's about as far as I can go. California uses the physical usefulness test, such that if there's any physical usefulness at all to the piece of paper, then that piece of paper is taxable. It is the law in California, and probably that is the only place where it is the law, because it's, quite honestly, it's a stupid test. It doesn't even make a whole lot of sense. It's kind of retarded. But so let's pick it up here. Okay, I'm sorry. I'll be better prepared next week. All right. So good night. Stay safe. I'll see you guys next week. If you want, good time for questions now on anything. And that's it. Okay, cool. Have a
Thank
good
you.
night.